Dan, thank you so much for coming.
Thank you for having me.
We were talking about the bloodbath since yesterday and even before, right? A little bit.
Well, in the markets, and also what I follow more closely is the gold market. And of course, as we know, gold's gone from 1925, 2 years ago, to 1275. So a lot of gold investors are feeling pretty low at the moment. But that's a decline of about 32%. And if we look back at 2008, gold went from 1,700.
If you go back to 2008, right? Because I wanted to slow down a little bit.
Well, yeah. My point is that the last gold correction in 2008, gold went from 1,000 to 700, which was a 30% decline. And 1,900 to where we are today is about a 30% decline. So in fact, it's the same decline on a percentage basis as last time. So gold bugs shouldn't be quite as gloomy as they are now. I think actually what's been happening in the treasury market is extremely bullish.
Exactly.
The long-term implications of gold. The gold correction really started when the Japanese started printing a lot of money. And it seems strange, they're printing money, that should be bullish for gold, right? They're printing more money, then gold should go up. It went down. And the reason it went down is that the Japanese were very surprised that as they printed money, bond yields started going up. In other words, they're buying bonds, but the price is going down, the yields going up. And what that means is that people holding levered accounts, which is almost everyone, get margin calls, and they have to sell something. So they hide around the portfolio, they sell gold, right? So long-term printing money is obviously bullish for gold. Short-term, when the bond markets start collapsing, it's very bearish because people get margin calls. When Bernanke had his recent press conference, right, he said, someone asked him, well, you're buying all these bonds. You're buying $85 billion of bonds a month. How come yields are going up? And he said, well, I'm puzzled by this. And that's just the moment when the Treasury bond market really broke, right?
That's right.
And so everyone holding, for 30 years, Treasury bonds have gone up in price and yields have gone down, right? And that means if you have a choice between holding cash and holding bonds, if you hold the bonds, you get the yield and you get the capital gain, right? So there's been a huge, for 30 years, people have been trained, hey, buy the bonds, don't hold the cash. Well, guess what? If yields start going up, that happens in reverse, right? All of a sudden, your capital losses exceed your coupon payment, and there's a scramble to get out. And it looks to me like that's what's happening. The Fed, they're still printing money. They're still buying $85 billion a month. And all they've said is, hey, guys, we might stop buying them in September. Not we will, just we might. And that's enough to make Treasury bond holders say, hey, I got to dodge. I got to sell these things now because I don't want to wait till September. And so what happens if the Fed really stops buying them in September? Right? What will it look like then? I think it'll be very, very ugly for the bond market.
No one puts it in a better perspective than you. And also in terms of Bernanke and the amount of bond that he's going to decrease it by, there were lots of rumors and speculations. Some say that in October we're going to see a $20 billion decrease, so it's going to be what, 65 billion. Some say that by the fourth quarter we're going to see 35 MBS, 35 Treasury.
Right.
I mean, is it really important, or what is your take on that?
I think that talks about the flow, how much bonds they're buying per month, right? I think the important thing for investors to consider in the long term is the stock. In other words, how much of these things do they own, right? And right now the Fed owns $3.5 trillion of very interest rate sensitive bonds. And so when rates go up, it means that the value of their assets go down, right? And the only reason Treasury bonds are high right now is because the Fed's buying them. So the second they stop buying them, right, the Treasury bond market is really going to get into trouble. And if you think about what the dollar actually is, what is the dollar? The dollar is a liability of the Federal Reserve, right? And it's backed by the assets at the Federal Reserve. So when the bond market collapses, which it will as soon as the Fed stops buying it, what that means is that the dollar will be in real trouble.
So why PIMCO's manager? Did you hear him?
Yeah, I did hear him.
Oh, you're misinterpreting Bernanke. Of course, he's the bond guy. Of course, we're going to hear this. But he says, you're forgetting that you need to take the inflation, the growth, the unemployment into consideration because it's an accommodative policy. What do you think about his comments?
It's not just him. It's everyone who sells bonds, right? He runs a bond fund. He's selling bonds to people. So he's going to tell you, hey,
don't sell.
Buy bonds.
Buy it.
And what's their theory? Their theory is, hey, the economy is getting worse, just like Bullard's saying, right?
Yes,
the economy's getting
Bullard
worse.
just said it.
So
we both read it. It said Fed should have waited on taper plan.
So they're saying, hey, the economy is getting worse, which I think it is. And so therefore, rates go down. And you think about it for a second, and you think, well, what if you were a company and you'd issue bonds, and you said, hey guys, things aren't rosy. Revenues are down and expenses are up. Would your bonds become more valuable or less valuable? And of course, the answer is they become less valuable. Yields go up. So why are these bond guys, why do they say, hey, things are going to get worse and bonds will go up, right? And they're saying that because we're not in a free market. They're saying, hey, the Fed's going to come in and they're going to have to expand QE. Right now, they may well be right, But if the Fed keeps printing money and the Japanese, and if the ECB gets involved, right, it can't be negative for gold. It can't be bad for asset prices.
Do you see ECB getting involved too?
Well, they have real stress right now because they're the one such a bank that's not printing a lot of money.
Exactly,
Yeah,
and there are some legal restraints too. How about gold? Let's go back to gold, okay?
Sure.
I know you're the gold guy, and I love the ants, by the way, by Murmichan's strategic update. Could you name your report consolidation?
Yeah.
Why?
A little prematurely. Well, because I think one of the things that has been driving the gold market down, again, are these tremors in the bond market where you get margin calls for investors, right? Well, that only lasts so long. You get a margin call, either you post more margin or the bank takes your assets, one or the other. So that burns itself out, right? But the real story is that long term, again, as I said before, if bonds go down, it means the Federal Reserve's balance sheet's in real trouble. And if the Federal Reserve's balance sheet's in trouble, it means the dollar's in trouble. The dollar will go down and all asset prices will have to go up. So I think having corrected 30%, which is the same correction as last time, I think we must be near the bottom here, especially given the fact that the Treasury market still, as we speak right now, is still in turmoil. The volatility is rising and yields are rising.
The volatility is definitely rising.
I mean, the whole premise of the Fed's intervention is to lower rates, to make things easier in the economy. Well, all their work is being undone right now.
Undone is very
Rates are going up, so that means that people's payments on their cars and their houses will go up. It'll be terrible for the economy. And for tax revenue.
Tax revenue is the same, that's true.
That's right, because all the Treasury bond is really, of course, is the debt of a Congress, right? There's $16.7 trillion of debt that Congress has run up. There's no possible way they can pay it, right? The CBO, the Congressional Budget Office, says that the deficit's getting better because tax rates have gone up and tax revenues have come in, and that's been true for the first 5 months of the year. But nevertheless, May was the 4th highest deficit ever for a month.
May, in terms of the month we had that, true.
So yeah, they're taking more money in, but they're spending more money too. And what happens if the commodity prices are going down too, not just gold, right? And that's telling you—
all of them.
That's telling you
but gold is leading the—
I know, but if you look at commodity prices and they're going down, it tells you economic activity is slackening, right? And that means that you're going to see less tax revenue going forward, and that means that you have less money to back the treasuries they've already issued.
What is your gold price target?
Well, let's put it this way. You know, people who bought gold at 1,000 in 2008 felt pretty stupid when gold hit 700, right?
Say it again slowly.
People who bought gold at $1,000 an ounce in 2008 felt pretty stupid.
That's true.
And you know, a few months later when it was at 700.
Yes.
Right? But they waited 2 years and it hit 1,900, up 2.5 times. I think the people who bought at 1,900 are feeling pretty dumb right now with gold less than 1,300. But just wait 2 or 3 years, and I think those people will be very happy they held on to their gold.
Thank you so much, Dan, for coming. It's a pleasure to have you.
Thank you so much.
I love reading your report and talking to you. It's like I get a history, freshen up, memory, and also going forward, your outlook is amazing and the analysis.
All these things have happened before.
It happened before. History repeats, doesn't it, Dan?
That's exactly right.
Thank you so much. Evet, söz tekrar sizde Gökhan.